Good morning, everybody. Today we want to talk a little bit about a subject that's been occurring with a great deal of frequency recently. That's market volatility. And a lot of people look at the ups, they look at the downs of the market, and they somewhat have become numb to it. And the problem with that is when the market's going up and we're making money, everybody feels really good. But when there's a correction, and we've seen a lot of correction here in the last 2 months, and really there's been a great deal of volatility this year. Whatever has caused it, economic reasons, political reasons, geopolitical reasons, any or all of those numbers can create uncertainty on Wall Street. And when you have uncertainty on Wall Street, you typically have sell-offs. And that's what we've experienced with the trade problems. None of that makes it very good for the average investor. But what most people don't know is they'll always say, well, you know what, the market will come back. Yes, the market will come back, but if you're getting close to retirement, you don't have the time to be able to wait out that period of time for the, quote, market to come back. And when the market doesn't come back on your time, when you need it to, you're going to be withdrawing money from an asset that's going down in value or has already dropped in value. And the problem with that is you're never going to get back to even again. And I say that with some degree of certainty because there have been numerous studies that have been conducted by Wall Street brokerage firms that say when you lose 25% in market value, and that has either the market or your own personal account, you've got to make about 33% to get back to even again. If you have a drop like we had in 2008 where the market dropped nearly 40%, you've got to make about 65% to get back to even again. And the problem with that is twofold. The first is in 2008 we dropped almost 40%. I cannot remember in over 40 years of experience in the market that I can sit here and tell you the market's gone up 65% in 1 year. It just doesn't happen. And the problem with that is if it doesn't happen in 1 year, if you don't get back to even in that first year following that big drop, then it's going to take you multiple years to get back to even again. And when it takes multiple years to get back to even again, and you're now in a position where you have to withdraw money from your account to live on, to exist, to pay your bills, that's that, quote, depreciating asset that we're talking about. You don't want to have to withdraw money, and you don't have the time. When you're 25 or 35 or 45 and you have a long working career ahead of you, you can continue to put money away in your retirement accounts. You can do the dollar cost averaging. All of those things are going to work just fine because you have time on your side. As you get close to retirement, or even worse, when you are in retirement and you lose that kind of money, you don't have time anymore to keep putting money away. Because chances are, as you near retirement, you're going to want to save as much as you can, but you don't have that 3 or 4 year period to get back to even. If you already have retired and the paycheck has already stopped, what are you going to do? Because you can't contribute to those plans anymore. So those types of things, those problems can destroy your retirement plan. Look at investments that have guaranteed not to lose money when the market has a correction. Make money when the market goes up and keep your gains every year as the market goes up and never give them back when the market goes down. Those are called hybrid indexed annuities. We would love the opportunity to talk to you about them. Thank you.